Good morning. Let's start our today's topic, which is I'm gonna I want to share with you a presentation. Well, our topic of discussion today is analysis of cost behavior. So, in which we identify various method to figure it out some costs, like as the description of this chapter or learning outcomes of this topic is describe linear cost function and their behavior, like how we can figure it out a linear relationship between various costs, explain the importance of causality in estimating cost functions. So we have to identify the cause and effect, like which one is the cause of a particular cost, and then we use those drivers and those activities to calculate the cost per unit cost. So understand the various methods of cost estimation. Uh, and there are specifically, we are talking about the four different methods. Outline the steps in estimating a cost function using a quantitative analysis, and also explain nonlinear cost functions, in particular those arising from learning curve effects. We add up little bit economics here, that because of learning experience, the labor become more productive, and because of that productivity, the cost goes down, and we will see the effect of those learning or experience effects on the cost. So let's start to see how we gonna start it. So as you all know, and it's very basic, like that, we can divide the overall cost of any production or any services the firm is rendering into three broader categories. One is variable cost, and the other one is a fixed cost, and the third one is a mixed cost. So as you all know, that variable cost is a cost which varies with the output. If we produce more, the variable cost is going to increase. So per unit, there is an increase. Fixed costs do not change in total in relation to some chosen activity or output. So fixed cost is fixed. It's not going to change over a certain range of output. And then there is a mixed cost. Mixed cost means a cost which has both the characteristics, like a certain portion of the cost is fixed, and the rest of the cost is based on the output or based on the consumption. For example, like the electricity bill, there is some fixed cost as a line rent, and then the rest of the things are based on how much units we are consuming. So by this way, there are many different in which you have to pay a certain amount as a fixed, and the rest of the amount is based on how much you are consuming, how much you are using. So that's the type of a cost, is a mixed cost. So these are the three costs. And when we try to mathematically describe how a cost change over a one output over a number of outputs. So we want to develop a relationship, like there's a fixed cost, there's a variable cost, and as the output is increasing, how they are behaving, how they are changing, whether it's a linear function or a linear relationship like one-to-one, or it's a non-linear or which are curved relationship, like initially they are increasing with the more values and then taper off. Or so these this is the way that we are talking about. So initially we focus on linear functions, and then we will also talk about the non-linear function as well. So we know that managers estimate cost based on two assumptions: variation in the level of single activity, the cost drivers, explains the variation in the related total cost. So that's a very linear equation. We all know from a very grade of in grade 8 onward, you learn that relationship. And in a statistics way, we can say is equal to y is equal to b minus mx. Right, that's a very statistical or very mathematical. But in accounting, we are representing like slope is a variable cost, means slope is changing. Slope is increasing over a period when how much a unit, if we produce one more unit, how much the cost is increasing, or we can represent it as a variable cost with the slope of the curve. And slope is fixed. In a linear function, slope is fixed, but in a very non-linear function, the slope is changing. So that's slope is a variable cost, and the intercept, like y-intercept, from where the graph is starting. Like if you if I draw here, so this is the slope of the curve, which is a variable cost, and this one is a y-intercept, and that is the fixed cost. So up till whether we are producing zero unit, this cost is going to be there, and that's what we call them as a fixed cost. And when we sum up this cost, both the cost, like total cost, y is equal to total cost. So and this is the way that we can write it, a very linear equation, y is equal to a plus bx. So a here is a fixed cost, like this mentioned here, and b is a slope or a variable cost. Like for every unit we are producing, it's going to increase. But here we are assuming that's a constant, or because it's a linear function. So this y is a dependent variable, and the cost that is being produced, predicted, and this x is a independent variable, how many units you are going to produce. So that's a cost driver as well. Now these are the three curves. These are the three linear curves. We can say like panel A, panel B, and panel C. Now we can see here that panel A is all variable cost. Why? Because it's starting from the origin. There is no fixed cost. You see here, there is no fixed cost. So it's starting from origin, and the slope of this curve is a variable cost, like have for every unit that much is increasing. So it's a basically a cell phone plan with the minutes of used. So you see here that's the minutes of used are increasing and the cost is increasing. So every minute is going to charge. There is no fixed cost in it. On the other hand, in the panel B, we see that this is a fixed cost. Like they say, okay, whatever you use, it doesn't matter. You have to pay 10,000 for 10,000 minutes. So up till 10,000 minutes, whether you use 1 minute or 10,000 minutes, your bill will be gonna be 10,000. So for that reason, there is no the slope is zero here. In this case, there is no slope, and we see here that all the flat line or a horizontal line is going to explain this is a fixed cost. And this line, if you look at this graph panel C, it's a mixed cost. It's starting from this point, means that there is a fixed cost of 3,000, and for every other minute you're going to charge. So in this case, the per minute cost is $5. In this case, there is no per minute cost. That's a fixed cost of 10,000. You can do unlimited calls up till 10,000 minutes, and unlimited calls, and there is no limit. So and in this case, the panel C, it's a mixed cost, like you have to pay up 2,000 as a fixed cost or a line rent type of things, and then every minute you're going to pay $2 per minute. So this is the way that we can explain variable cost, fixed cost, and mixed cost. Now, criteria for classifying variable and fixed component of a cost, like how to choice of a cost object, like different objects may result in a different classification of the same cost. The time horizon is also important. The longer the period, the more likely the cost will be variable. It's not fixed, because over a period of in economics, we say that in the long run, all costs are variable costs. There is no fixed cost. And then there is a relevant range over which the cost is fixed, right? So cost behavior is predictable and considerable, a linear cost function within the range of activity. Like if you have a certain capacity in which there are certain costs are fixed, but if you change the capacity in a longer time, so your fixed cost is going to also change. So that's the over a relevant range is important to understand. Up till certain level, the cost is fixed, but after that, the cost is going to be increase, or the fixed cost is going to be also increase or decrease if we change the capacity. The cost and effect criterion that we have to understand the relationship in a way. The most important issues in estimating a cost function is determining whether a cause and effect relationship exists between and the level of an activity and the cost related to that level of activity. The cause and effect relationship might arise as a result of a physical relationship. We can see that how much material is using, how much labor is using between the level of activity and the cost, or a contractual agreement, like if we is doing some written agreement, okay, for this per unit we're going to pay you this much amount, so that is considered to be again uh, uh, cause and effect relationship. And the knowledge of operation, sometimes because of the expertise or knowledge, they estimate or they calculate that okay, this much cost is allocated to this particular object, and they know that there is a cause and effect relationship. So high correlation connection between activities and the cost does not necessarily means causality. So causality you have to determine with the either you can physically see that, or you can have a contractual agreement, or there's an expertise that can say that there is a cause and effect relationship between these two, what we are estimating. So the four methods of cost estimation for any activity or any product we are producing, there are four methods. The first one is an industrial engineering method. It's a very technical method based on their engineering skills as well as the mathematical calculations. So method have a different now. Uh, then we have a conference method, means that we sit together like a conference between different department expertise, and then they allocate the cost between different departments and different products. Then account analysis method, we focus only on the numbers we are generating from our accounting books. That is method we can say. We will discuss a little bit in detail these all the four methods. Quantitative analysis method, that's a method in which use we collect data. The data is collected over a longer period of time, and then analyze the data through different statistical tools like a regression analysis or data analytics. So we use the not a accounting book data, but a data which we collected like over a longer period of time, and then use that data to statistically prove that this relationship is exist between these cost and the product. So we see this, there are four methods. Methods have a different implementation cost. So these all four methods have a different implementation cost based on which method we are using. Assumption, Assumptions and information provided about accuracy of the estimate cost function. So many organizations use multiple methods, not a one method they use. So the first method which we discuss is industrial engineering method. In industrial engineering method, as I mentioned, it's a technical method, and it's very specific to particular industry or a particular operation. So estimate cost function by analyzing the relationship between inputs and outputs in a physical term. Includes time and motion studies, very thorough and detailed, but also costly and time consuming. And it is not understandable for everyone because it's a very technical, specifically to the physical and time and motion studies. And so people in some organization they use this method as well. The second method, as I mentioned, conference method. Conference means collecting the expertise from all the departments of the operation and then analyzing. So estimate cost on the basis of analysis and opinions about cost and their drivers gathered from various departments of the company. So pool expert knowledge, encouraging interdepartmental cooperation and creating credibility. So reliance on opinion still makes the method subjective. So as you know that this is the opinion of a certain experts from different departments. So again, this is a subjective. This is not a quantitative in which we can figure it out. But they want to explain you this with their expertise that there is a cause and effect relationship between these two. Uh, the third one is account analysis method. So estimate cost function by classifying various cost accounts and variable, fixed or mixed, with respect to the identified level of activity. Is reasonable, accurate, cost effective, and easy to use, but is again subjective because the accountants are deciding that which cost is going to be allocated where. Uh, While used in the industry, so this is very commonly used because the cost accountants or managerial accountants from different corporations or firms are using that to maybe distortions due to time lag between incurring a cost and receiving benefit. As you know that the accounts are finalized after a year or after a certain time period, so it's a time lag. Like if we want to know the time from the books of accounts, the cost, then we have to wait till the accounts are finalized, and then later on we can analyze them and then figure it out. The quantitative analysis, and which is the focus of our today's discussion, is quantitative. Qualitative analysis, like using a formal mathematical method such as low-high method and regression analysis to fit cost function to past data observation. So as I mentioned, they collect the data over a longer period of time, and then they use low-high method or the regression analysis in order to figure out the relationship or the behavior of the cost for the output. So uh, what are the advantages of this qualitative analysis is uh, st uh, now steps in estimating cost functions using quantitatives. This is the heading is not correct. I think here it is quantitative, not qualitative, because statistical method. We are using a statistical method, so it's a quantitative method. Correct it. I will correct it. So it's a quantitative method in which we choose a dependent variable, like what is going to be the outcome, like the total cost or the variable cost or the fixed cost, and the cost to be predicted, and identify the independent variables or a cost drivers like an output or a service or a so this is our independent variable, and dependent variable is our cost. So that's the way that we can uh, your in physical terms, that can be a output in terms of unit, or if we are providing service to our customers, so per service or per customer. So that's the dependent variable is a cost, and the independent variable can be a one output in shape of a unit of output, like if you are producing shoes, so pair of shoes, or if we are producing furniture, so per furniture or chair per chair, or if we are providing services like per customer or per patient or so. So this is the way that the patient is our independent variable. So collecting data, so on the dependent variable and cost drivers, plot the data, then we plot the data and estimate the cost function using the high-low method or a regression. So there are two methods what we are discussing here to figure it out, the relationship in a mathematical way. Uh, One is a high-low method, and the other one is a regression analysis using the data. So data is collected for cost drivers or um, uh, uh, dependent variables and independent variables, and then we use those data to either plot it over a graph and see that is there any relationship exist or not. So evaluate the cost drivers of the estimated cost function and economic possibility and linear continuity. So, for example, this is a activity plot, and this is an activity plot between cost driver machines hour, like how many machine hours we are using, and there here is a like a indirect manufacturing labor cost. So this is a indirect manufacturing labor cost. We want to allocate it, and the driver we believe is that it is a machine hours. Now, when we plot the data for different observations, and we see that these observations are in such a way that they reflect some pattern, like they are as the machine hours are increasing, and the indirect manufacturing costs are increasing. Now, when we see that there's a pattern exist, it means that there is some relationship, and we can figure it out, this relationship, or just what we discussed in the beginning, and the slope of the curve. So first of all, what we have to do is we see that that is there any mean value or that can exist in between that can represent this. So the first method is a high-low method and simplest method of a quantitative analysis. Uh, use only the highest and the lowest observed value. Like here in this case, we see that highest observable value and the lowest value, and then we can use those to figure it out. So how we can figure it out here? Uh, Cost associated with the highest activity level minus cost associated with the lowest activity level and divided by the highest activity level minus lowest activity level. So in our case, we see here that the highest cost is around 1400 and the activity level is around 95 or 90, 98 or so it's just reading this graph. So, and the lowest one is around 700 and around 43. So we can see here this example. Uh, Summarize in a linear equation, fixed cost, variable cost per unit activity into activity. So we have to write it like y is equal to FC plus uh, mm, variable cost per activity into activity, number of activities. So we see here the same observation, and as I mentioned, and the highest point is 1456. 1000, the highest observed value from our data is 1456. That is the cost against the activity of 96 minus this is the lowest like 710 and the activity level is 46. So we divide the highest costs like 1456 minus 710 divided by 96 minus 46, and we get it like 14.92 per machine hour. 14.92 per machine hour. So we can see here that the mixed cost at a high point is 1456 minus 96 into 14.92. So we get it like 23.68. So that's the way that's we calculate the fixed cost. Variable cost is 14.92 and we figure it out the fixed cost. So the fixed cost is 23.68 per week, and the variable cost is 14.92 per machine hour, right? So that's the way that we can write an equation. Uh, we can write an equation in say way fixed cost plus variable cost into activity level. So whatever the activity level is, we can estimate the cost in a way that 23.68 per week plus the 14.92 into if we are producing volume of 50 or 100 or 150. So we multiply 14.92 and plus 23.68. So this is the way that we can use low and high method. But low and high method is not so accurately providing us a figure because they are ignoring all other observations. We are just focusing only on low end, and sometimes there is a possibility of outliers because of any reason. So in that case, it is difficult. So we see here total cost from either the highest or the lowest activity level minus variable cost per unit of activity into activity associated. So this is the way that we can calculate the fixed cost. So variable cost, fixed cost, and we use here an example to figure it out that. Now, the other method as I mentioned, is a regression analysis. That's a statistical tool we use, and we can run by using various mathematical or statistical softwares like R or like we can also run the regression in Excel as well. But there are different ways that we can run regressions by using different regression analysis is a statistical method that measures the average amount of change in the dependent variable associated with the unit change in one or more independent variables. Is more accurate than the high-low method because this is more accurate because regression analysis equation estimate using information from all observations as compared to the low and high method is only focusing on the highest and the lowest. Uh, Types of regressions, there are two types of regressions that we can run. One is a simple, there is one independent variable and one dependent variable. That is called as a simple estimation between dependent and variable, independent variable. But we can also run multiple regressions, estimating the relationship between the dependent variable and two or more independent variables. So we can use that as well. Now here the same observation, like, but we see, as I mentioned, that we have to draw a line that is mean of the values of all the observations. Now, if you look at this graph, uh, so if you look at the graph, we see that this line is passing in between all these dots or observations. The beauty of this line is that if we calculate the difference or variance between these observations and the line, and we call them as a residual value or a residual term of all these observations, when we sum up, because there are some are dots are below the line and some are above the line. So it means that there are some have a negative difference or a variance from this line, and some have a positive variance with this line. So when we sum up all these, the value is going to be zero. So this is what we call it as a goodness of fit, indicates that the strength of a relationship between the cost drivers and uh, cost. So if we get also the R value here, and that's going to give us a goodness of a fit. Residual terms measures the distance between the actual cost and the estimated cost for observation. And we see that the relationship we are getting here is 398 plus 10.31x. So y is equal to this. We can write this regression uh, in this way. And you see it's very similar like the one method, low and high method, high and low method. But here it's coefficients. This is a y-intercept, and this one is, or we can call them as a constant. And this one is our coefficient for x, and this is also the slope of this curve over a relevant range. So the cost function for which the graph of a cost is not a straight line within the relevant range, that can be because of the economies of scale and the quantity discount. So the cost can be changed over a longer range because we can get some discounts for our costs. And also keep it in mind that when we produce the goods in a large quantity, we're going to reach to the level which we in economics we call them as a economies of scale, where your average total cost is reaching to the minimum point. That's is possible when we increase the output. So that can cause the cost function as a non-linear, because when we further expand our output, so the cost go down. So it means that the relationship is not existing like which is in the beginning or at the short range of operation. So step cost function, resources increase in lot sizes, not individual. So that is also possible that the relationship is not linear. It is stepping up for every 10 or after every 20 output. Like for example, if we are running a clinic and we are providing a cost relationship between a doctor and a patient. But if the doctors increase, if the patients increase for more than 20, so what we have to do? We have to hire one more doctor so that we can cover that. So that's the step cost function. So learning curve, as I mentioned in the beginning, because of the experience, because of repeated work of labor, there is a concept that the output will increase or the productivity increase with the reduction in with the repeated production, and by this way the cost reduce. So we see here this is a nonlinear curve or a nonlinear relationship between the cost and the driver. So we see here that initially in the beginning the slope is 25 per unit, and then it reduced to 15 per unit, and then further reduced to 10. So it means that it is going to be an increase. So the effect of a quantitative discounts or a slope of a coefficient of direct material cost is function. So this is a material cost with the output. As we are using more and more material because we are producing more output, so it means that we are able to get some bulk discounts on buying a material. Uh, so in the panel B, step variable cost is step up costs and the units of production. So as we are producing more and more, so the cost is increasing in a step form. It's not a linear form. And the other one is also relevant range concept, like up till the 7,500 output, the cost is fixed, like a 300 per unit, 300 in thousands per unit. And then if we produce one more than 7,500, the cost is increased to 600 per unit. And then after 15, there's a reach to 9,000 per 900 per unit. So this is the way that it works in a step fixed cost function. Uh, so this is the first part of this chapter in which we focus. If I summarize what we discussed, we want to discuss a cost behavior, how the cost behave over a certain range of output. So as the output is increasing, the cost is increasing in what way? So in the beginning, we assume that there's a linear function, and we describe that the cost, which is a independent variable, is equal to there is a constant or a fixed cost plus the slope of the curve into the dependent variable, which is the cost driver. So that slope is our variable cost. So this is the way that we describe. And then we discuss four different methods to figure it out, the relationship, this type of the relationship between the cost and the drivers. And after that, we focus only on a quantitative measure, and in a quantitative measure, we discuss high and low method or regression analysis. And then later on, we discuss also there is a possibility that the relationship is not necessarily that is a linear. It can be a non-linear function, like a curved relationship or a step-up relationship or a relevant range relationship. So this part is stop here.